What if I told you that the most powerful financial empire in the world started with just 24 men standing under a tree? That a simple handshake agreement signed in 1792 would eventually control trillions of dollars and shape the fate of nations? Today, Wall Street processes over $169 billion in trades every single day. But its origin story is far stranger and more dramatic than you might imagine. From a small buttonwood tree on a muddy street in Lower Manhattan to the glass towers that now dominate the global economy, this is the incredible true story of how American capitalism was born. But here's what makes this story dangerous. Wall Street didn't just evolve, it was designed. Those 24 men weren't visionaries building a fair marketplace. They were insiders creating a club, and every mechanism they built to protect the market protected them first. Today I'm taking you inside the machine. Not the Wall Street of Hollywood movies, but the actual architecture of modern finance, the algorithms, the incentive structures, the legal loopholes that turned a simple exchange into a wealth extraction engine. By the end of this video, you'll understand why your investment returns look the way they do, and why the house always seems to win. This isn't a conspiracy theory. It's just how the game was built. Let's start at that tree. May 17, 1792. Lower Manhattan. The United States is barely a country. George Washington has been president for 3 years, the Constitution is still warm from the printing press, and the economy is chaos. There's no central bank, no Securities and Exchange Commission, no rules, just merchants, auctioneers, and speculators shouting prices in coffee houses and on street corners. It's the Wild West, except everyone's wearing powdered wigs. Then Alexander Hamilton, yes, that Hamilton does something radical. He consolidates all the state debts from the Revolutionary War into federal bonds. Suddenly there's something to trade. Real securities backed by an actual government. And where there's something to trade, there's money to be made. Enter our 24 gentlemen, brokers and merchants who realize they're competing with auctioneers taking massive commissions, sometimes 0.5% per trade, which in 1792 is basically highway robbery. So they gather under a buttonwood tree at 68 Wall Street and sign an agreement. They'll only trade with each other, and they'll charge a fixed commission rate. Sound familiar? It should. They just invented the cartel. The buttonwood agreement wasn't about creating fair markets. It was about controlling access. You want to trade securities? You go through us. You want better prices? Sorry, we all charge the same. It's the original pay-to-play. And it worked. By 1817, they'd formalized into the New York Stock and Exchange Board. The club had a building. The building had rules. And the rules had one purpose: keep the money flowing to members. Fast forward to today. That buttonwood tree is long gone, replaced by server farms in New Jersey processing 4.5 billion trades per year. But the fundamental architecture? Still a members club. Just with better technology. Let me show you how deep this goes. You open your Robinhood app. You see Apple stock at $185.42. Looks simple, right? You click buy. Behind that click, a cascade begins. Your order doesn't go straight to the New York Stock Exchange. It goes to your broker. Let's say Robinhood. Robinhood doesn't actually send your order to the exchange. They sell it to a company you've never heard of, like Citadel Securities or Virtu Financial. This is called payment for order flow, and it's worth roughly $3 billion a year to these middlemen. Why would someone pay for your order? Because they can make money on it before it executes. Here's where it gets surgical. These market makers, the modern descendants of those 24 men under the tree, they see your order to buy 10 shares of Apple at $185.42. They have supercomputers collocate in the same data centers as the exchange servers. Collocate means their machines are literally closer to the exchange, measured in feet, which translates to nanoseconds of advantage. In the 380 milliseconds it takes your order to process, their algorithms have already scanned every exchange and dark pool for available Apple shares, calculated the optimal execution price, bought shares at $185.41, sold them to you at $185.42. 1 penny times 10 shares. That's 10 cents on your trade. Multiply that by billions of trades, and you're looking at Citadel Securities making $7.2 billion in revenue last year alone. You didn't lose money. The trade went through at the price you saw. but you paid an invisible tax. The spread between what they bought for and what they sold to you. It's so small you'd never notice. That's the genius of it. Now let's talk about the thing Wall Street guards more jealously than money itself: information. You've probably heard information is power. On Wall Street, information is the only power. And the game is rigged from the ground up to ensure you're always playing with yesterday's news. Bloomberg terminals. If you've never seen one, imagine a computer from the future had a baby with a fighter jet cockpit. It costs $27,000 per year per user. Wall Street has 325,000 of them. That's $8.8 billion spent annually just on having better information than you. What do you get for $27,000? Real-time data, news feeds that update milliseconds before they hit public channels, analytics tools, direct messaging with other traders, economic indicators, bond prices, currency flows, basically a god's eye view of global finance. Meanwhile, you're getting your stock tips from Yahoo Finance, which updates every 15 minutes during trading hours. You're not playing the same game. You're not even on the same planet. But it gets worse. Ever heard of dark pools? Dark pools are private exchanges where institutions trade large blocks of stock away from public markets. The name isn't sinister by accident. These trades are literally invisible until after they're executed. Right now, about 40% of US stock volume happens in dark pools. Why? Because when a pension fund wants to buy 10 million shares of Microsoft, they can't just place that order on the NYSE. That would move the price immediately. Everyone would see the big order, the price would spike, and the fund would pay more for every share. So they use dark pools. Secret trades. And here's the thing. You don't get access to dark pools. You don't even see the trades until they're reported after the fact. By the time the price moves on your screen, the big money has already positioned. It's like playing poker where some players can see everyone's cards, and your hand is dealt face up on the table. Now let's talk about high-frequency trading, because this is where Wall Street stopped being a market and became a physics problem. In the early 2000s, exchanges went electronic. Suddenly, you didn't need humans on a trading floor shouting orders. You just needed a fast computer. And then someone asked the billion-dollar question: how fast is fast enough? Turns out there's no such thing. Michael Lewis wrote about this in Flash Boys. Traders realized that light traveling through fiber optic cables between Chicago and New York took about 14 milliseconds. So they spent $300 million to drill a straight line through mountains and lay a faster cable. They shaved it down to 13 milliseconds. 1 millisecond faster than the competition. That 1 millisecond was worth $300 million because in that time, they could see price changes in Chicago and execute trades in New York before anyone else. It's not insider trading. It's physics arbitrage. But here's what makes this insidious. These firms aren't investing in companies. They're not allocating capital to productive businesses. They're extracting value from friction. They've turned the market into a highway system and stationed themselves at every toll booth. And who pays the toll? You do. Every pension fund, every mutual fund, every time your 401k rebalances. Those aren't trades, they're donations to the speed merchants. There's a reason the average holding period for a stock on the NYSE is now 5.5 months. In the 1960s, it was 8 years. The market stopped being about ownership and became about velocity, because velocity is where the money is, if you're fast enough to tax at point zero. Wall Street will tell you that high-frequency traders provide liquidity. This is their golden excuse. We make markets more efficient. We narrow spreads. We ensure you can always buy or sell. And you know what? It's technically true. Until it isn't. Let me explain liquidity the way they don't want you to understand it. Liquidity means you can convert your asset into cash quickly without affecting the price too much. That sounds great. You own Apple stock, you can sell it instantly. But liquidity isn't a public service. It's a product. And like any product, someone's selling it to you at a markup. Market makers are supposed to provide liquidity by always offering to buy and sell. The spread between their buy price, the bid, and sell price, the ask, is their profit. In normal times, that spread on Apple might be 1 cent, totally reasonable. But on March 16, 2020, remember the COVID crash? Spreads on major stocks exploded to 50 cents, sometimes $1. The very moment you needed liquidity, it evaporated. Because high-frequency traders aren't obligated to provide liquidity. They just do it when it's profitable. It's like having fire insurance that's super cheap when your house isn't on fire. But the moment you smell smoke, the insurance company quadruples the premium and suggests maybe you don't really need coverage right now. That's not a market. That's a hostage situation with extra steps. And here's the part that should make you angry. These same firms lobby against regulations that would force them to maintain liquidity during crises. They want the profits of being essential infrastructure without the responsibilities. They've privatized the upside and socialized the risk. When things go wrong, like the 2010 flash crash where the market dropped 1,000 points in 5 minutes, regulators scramble to add circuit breakers and kill switches. Band-aids on a system that's fundamentally designed to reward speed over stability. Institutional traders call this information asymmetry. I call it a masterclass in legalized advantage. So where are the regulators? Where's the SEC? The watchdog that's supposed to protect retail investors? Oh, they're there. They're writing rules. Lots of rules. The problem is Wall Street writes them first. Here's how it works. You're a skilled lawyer at the SEC. You make $160,000 a year enforcing securities law. You're good at your job. You understand the intricacies of high-frequency trading, dark pools, and derivatives. Then Goldman Sachs calls. They'll triple your salary to come work in their compliance department, which is just code for teach us how to avoid the rules you used to enforce. This is called the revolving door, and it spins fast. The SEC's former chairman, Jay Clayton, he came from Sullivan and Cromwell, a law firm that represented Wall Street banks. When his term ended in 2020, he went to work for Apollo Global Management, a private equity firm. This isn't corruption in the traditional sense. It's alignment of incentives. Regulators know that if they play nice with Wall Street, there's a lucrative exit waiting for them. You don't bite the hand that might feed you a 7-figure salary. The result? Regulations that look tough but have loopholes you could drive a Brinks truck through. Take the Dodd-Frank Act, passed after the 2008 financial crisis. It's 2,300 pages of rules designed to prevent another meltdown. Know what Wall Street did? Hired armies of lawyers to find every ambiguity, every exception, every way to technically comply while doing exactly what they were doing before. The Volcker Rule, for example, was supposed to stop banks from making risky bets with depositor money. Sounds great, except it allows market making and hedging, which are so broadly defined that banks can claim almost any trade falls under those categories. So after all of this, you might be wondering, is Wall Street evil? No, it's worse than that. It's rational. Every mechanism I've described, payment for order flow, high-frequency trading, dark pools, regulatory capture, these aren't bugs. They're features. They're the natural evolution of a system designed by insiders for insiders, optimized over 230 years to extract maximum value from everyone else. The guys under the buttonwood tree weren't villains. They were entrepreneurs. They saw an opportunity to control a choke point and they took it. Every generation since has done the same thing, just with better technology. The real question isn't, how do we stop them? It's how do you stop playing their game? Because here's the secret they don't want you to know. Wall Street's advantages disappear over time. All of them. High-frequency traders can front-run your trade by milliseconds, but they can't front-run your 30-year investment horizon. Dark pools can hide institutional moves, but they can't hide a company's earnings over a decade. Information asymmetry matters when you're day trading, but it's irrelevant when you're dollar-cost averaging into index funds. Warren Buffett, the guy who's beaten Wall Street for 60 years, doesn't have a Bloomberg terminal. He doesn't trade in dark pools. He doesn't optimize for nanoseconds. He reads annual reports and buys companies he understands. Then he waits. The game Wall Street wants you to play is fast, exciting, and rigged. The game you should play is slow, boring, and mathematically in your favor. From 24 men under a tree to supercomputers in New Jersey, Wall Street has always been about one thing: controlling the flow. They built the rails, they charged the tolls, and they wrote the rule book. But you have something they can't beat: time. Because while they're optimizing for microseconds, you can optimize for decades. That's the game they can't rig. If this video changed how you see investing, hit subscribe. We're pulling back the curtain on systems designed to stay hidden. Drop a comment with the biggest revelation you had watching this. I read every single one. And here's your homework. Open your investment account and check how many trades happened last year. If it's more than a dozen, you're probably feeding the machine instead of building wealth. Next video, we'll break down how one man crashed the economy. See you there.